Hello, clients and friends. This is Billy Doty once again from Doty Financial. It's my pleasure to welcome you to our Economic Review and 2022 Outlook. Today, we will be providing a brief review of the fourth quarter of 2021, and then we will discuss our economic outlook for 2022. Before we begin, it's always important to review that there are 5 key areas of financial planning. These areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendations we make on not just one but all of these areas for our clients. Today's presentation will be primarily focused on investment planning and equity markets. The U.S. stock market ended 2021 just shy of all-time highs. The S&P 500 closed the quarter at 4766, ending the quarter up 11% and the year up 27%. This marks the third consecutive year the S&P ended the year with double-digit gains. The Dow Jones Industrial Average closed at 36,338, ending the quarter up almost 8% and the year up 19%. Since the quick but sharp fall of equity markets in early 2020, post-pandemic equity markets have been primarily robust. Despite many potentially detrimental events, the equity market showed resilience and prevailed, rewarding investors with notable gains. 2021 saw many new records broken. The S&P 500 had 70 record closes, and the Dow also saw some significant gains with 45 record closes. Stock valuations have soared, and many analysts are crediting ultra-low interest rates and a healthy economic recovery for this surge. As you look at this 40-plus year chart of the Dow, you can easily see that stocks have increased over the long term, notwithstanding market pullbacks and dips. The sharp decline of 2020 looks a lot less threatening as you look at long-term results. That's why having a solid investment strategy is an integral part of a well-devised long-term financial plan. Staying disciplined, not getting emotional, and following your strategy during times of volatility can be crucial and is important. While investors enjoyed an overall strong return in 2021, as the monthly S&P 500 returns chart shows, monthly returns were very inconsistent. Equity markets do not move in a straight line, and the past few years have been an excellent reminder for investors to be prepared for anything that could affect the economic environment and their own personal situation. Volatility is a part of the investment experience, and seasoned investors understand that. Bond yields for 2021 were low. In mid-March, we saw the highest 20 and 30-year yields on U.S. Treasuries for 2021. Subsequently, they dropped back down, ending the year at 1.52%, 1.94%, and 1.9% for 10, 20, and 30-year yields, respectively. 2021 was not a great year for bondholders. While today's interest rates are still historically low, the Fed is expecting to raise interest rates several times in the next 2 years. When interest rates rise, the demand for bonds typically falls, reducing their prices and raising their yields. Thus, 2022 will be an interesting year for bonds. Research is indicating that Treasury yields could go up, ending 2022 with a 1.5% to 2% yield on 10-year U.S. Treasuries. As I mentioned earlier, interest rates continued to be ultra low throughout 2021. These rates clearly are undesirable for income-seeking investors. Bank money markets and the average 12-month CD rate were both less than 0.2%, which is very unattractive to savers and investors. During the Federal Open Market Committee's meeting in December, it was announced that federal funds rates will increase in 2022. And the Fed expects 3 rate hikes this year, following by 3 more in 2023. They project that by the end of 2023, the federal funds rate will rise to 1.6, and in 2024, end the year at approximately 2.1. The Fed has been making lots of moves. They also began the tapering process this past fall, with the ultimate goal of ending the pandemic-driven stimulus by mid-March of this year, several months earlier than their original goal of November 2022. In December, due to the elevated labor market and inflation pressures, the Fed decided to double the pace of reduction of asset purchasing beginning in mid-January. Inflation rose at the fastest pace in nearly 4 decades in December of 2021. The number reported was 7% versus the prior year. Seema Shah, chief strategist at Principal Global Investors, stated, "Inflation at 7% is no joke. It's the highest annual number since 1982 and was driven not by energy prices, but by just about everything else." While analysts feel December's number could mark the peak for annual inflation readings amid signs that supply strains are easing, other experts suggested the rampant spread of the Omicron variant could bring about new difficulties for the global supply chain. Many analysts feel the tapering process of the Fed could slow inflation down. Inflation is clearly on our watch list for 2022. So what are analysts forecasting for 2022? 2022 could be a volatile year, and our goal is to keep our clients appraised of any potential activity that may affect their financial situation. In addition to continued COVID concerns, 2022 is projected to bring rising interest rates, continued but hopefully lower inflation, stimulus tapering, and a slowdown of the global economy. Also, let's not forget any public policy and new tax laws will bring changes to monetary policy. What does this all mean for investors? The returns we have enjoyed the last few years were well above average and the typical median of the past 20 years. However, there are still many economists that feel with rates still low, we should be optimistic and could be still looking at favorable returns, just in more moderation. While the most recent variant of the coronavirus, Omicron, is being seen as much less of a threat as its predecessors, and vaccines are now widely distributed, it is still a central figure in the direction of the economy and its recovery. We were reminded in November when news of Omicron was released that the markets are still very vulnerable to the trajectory of the coronavirus and the introduction of new variants, as it directly affects supply chain disruptions, labor shortages, and further downward pressure. Even though the equity markets have seen impressive returns, complacency should not settle into investors' attitudes toward their investment strategies. We're still standing by our mantra of proceed with caution. We also still maintain that an educated client is our best client. So here are some things we're looking at. With interest rates on the rise, we feel it is beneficial to review all your income-producing investments, lock in your mortgage rates, or consider refinancing to get a better rate if you haven't already done so. Maintain liquidity for all near-term needs. Reevaluate and confirm your cash flow needs. Sometime this year, conduct a full review of your financial plan with us. During this review, we can look at risk management, how well diversified your plan is, and revisit your time horizons to make sure all these items are still compatible with your goals. Remember, if volatility returns this year, it is part of the investment experience. Let's go back. Sorry, let's get back to, okay, here we are. So having a long-term strategy and staying away from emotional investing decisions can help you ride the pullback waves and stay on track toward your financial goals. As a reminder, focus on your time in the market, not timing the market. For example, selling equities during a downturn can help you retain your gains, but if you're still on the sidelines during an upswing, it could prove disadvantageous to the overall performance of your portfolio. If you have any questions or concerns, now is a good time to revisit your financial plan with us, including your time horizon and risk tolerance. As a quick recap, equity markets ended on a high note in 2021 despite many potentially negative variables. Inflation is still expected to be prominent in 2022. The Fed announced we should expect 3 rate hikes in 2022. Tapering efforts of the Fed will double starting in mid-January. Volatility could be on the horizon. Caution and vigilance are critical. You should focus on your own personal goals and objectives. And as always, call us with any concerns. So, what can you expect from us? As your financial professional, we are here to help you pursue your goals. One of our main focuses is to review potential changes for our clients on an ongoing basis. Prior to making any financial decisions, we highly recommend you contact us so we can help determine the best strategy. There are often other factors to consider, including tax ramifications, increased risk, and time horizon fluctuations when changing anything in your financial plan. You can also expect regular communication and the confidence that we are continually reviewing economic, tax, estate, and investment issues for our clients. In fact, we will be offering other workshops that focus on tax changes and planning ideas. We appreciate our clients. As a client benefit, you can add names to our viewing list for the workshops we present. We hope you will take advantage of this and add 2 names to our list. One of our goals in 2022 is to help more people just like you. Some of our best clients will refer to us by existing clients. Please feel comfortable sharing the names of anyone who you feel could benefit from this information. We believe the best client is an educated client. Our goal is to keep you informed, and we thank you for watching this update. Best wishes for a great and healthy 2022. Please call us if you have any questions. And once again, thank you for listening to this workshop. We appreciate the opportunity to assist you with your financial needs. Please let us know your preference on meeting format, whether you like them in person or virtually. Remember, at our firm, clients come first, and your health and well-being is our highest priority.